Hi, this is Samer Hilal, your trusted financial advisor from Cleveland, Ohio. Today I want to talk to you about bonds and interest rates and the inverse relationship between them. We're hearing quite a bit about the inflation that's happening in our economy now and how the Federal Reserve is moving interest rates higher to try to tackle or control inflation. So I wanted to discuss how that affects the price of bonds. Typically, when you're studying finance, the basics in finance tells you that there is an inverse or negative correlation between bonds and interest rates, meaning if interest rates are climbing, the price of bonds that have already been issued goes down in value, and the opposite is also true. So the best way to illustrate this is to look at an example. Let's say hypothetically a year ago you bought a 10-year treasury, and that 10-year treasury at the time was yielding 1.45. And now we're sitting a year later, you are just reviewing the purchase you made a year ago. And you're saying, hey, Samer, I bought this bond 10 years ago. What happens if I buy another bond today similar to it? Well, what happened in the last 12 months is rates went up, like I said. And today, if you're buying a 10-year treasury, you are going to get a yield of about 3.25%. Meaning you will receive 3.25% in interest per year for the next 10 years. So what happens if you want to sell the bond that you purchased a year ago? Because keep in mind, bonds tend to trade in the secondary market just like stocks. Once they have been issued, they can be bought and sold in the secondary market. So if you want to sell the bond that you bought a year ago because you need the money for some reason, what's going to happen? Well, you're not going to get the price you paid because rates went up in that year since you bought yours. So think about this. You are competing with those bonds today that are paying 3.25. Yours is paying 1.75, which means you have to lower the price that you're asking for your bond to the point where you're turning the yield into at least 3.25, if not a little bit higher, to attract a buyer. Because the buyer has a choice to either get that new bond being issued at 3.25 or buy yours. So effectively what happens is when rates went up, the price of your bond went down, and the opposite is also true. So we know that we are facing inflation. Inflation is high. The Federal Reserve is trying to control it by raising rates. They've already raised rates by 1.5 percentage points through June of 2022. And they are expected to continue to raise rates throughout the balance of the year. So if that turns out to be the fact and rates continue to go up, then that's not necessarily boding well for the bond market moving forward. So is that truly going to happen? Is the bond market already factored in rates going up? Well, that's the million-dollar question. But in the meantime, if you have any further questions on this or you want to discuss it further, I'll be happy to take your call. So reach out and let's talk. Thank you.